Welcome back. Now we'll look at where markets ended a week of record highs. And after we got the latest data on inflation for the month of July, year over year, consumer prices are holding steady at 2.7%. There was, however, a surprise spike in wholesale prices, up 3.3%, leaving some investors to question the expectations for an interest rate cut next month. I spoke with Treasury Secretary Scott Bessent about it. Here's what he said this week.
Based on the 50 basis point cut in the September of 2024, right before the election, that the conditions now they are slightly more favorable for a cut. But again, I believe that there is room, if one believes in the neutral rate and where it is, that there is room for a series of rate cuts.
Joining me now is San Francisco Federal Reserve Bank President Mary Daly. Mary, it's great to have you. Thanks very much for being here. And I know you told the Wall Street Journal that you did not see a need for a cut of 50 basis points or more next month. Why not?
Well, we really have to balance both of our goals. We have inflation printing above target. 2.7 is not 2%. And Americans have waited a long, long time to get inflation back to our 2% target. So I don't want to give up on that goal. I want to finish the job. But we also have a softening labor market. Want to make sure we're supporting that. You know, ultimately, when I'm out in my communities talking to CEOs or households, they say that they want jobs and low inflation, and we're trying to deliver both. And so making a more gradual move and a series of moves as the economy warrants it, I think that's the appropriate place to be.
So based on what you see for the future and looking longer term, would you expect a series of rate cuts in the future?
Well, you know, we have room to recalibrate, is how I would put it, the policy rate. So we are now at, over 4, and we think the neutral rate is around 3%. So that gives you room to do that. And then we'll make those adjustments as we go. But, it's important to remember that policy acts with a lag. And so we're looking 6, 12, 18 months ahead and asking where's the economy going to be once tariff shocks have worn off in the goods price sector, the goods inflation, and we're back to an economy with a sustainable pace of growth and lower inflation. Where do we want to be? And I think that would warrant a couple of cuts sometime this year. Of course, we will wait to see the data, and maybe it'll be fewer, maybe it'll be more. But ultimately, I think 2 remains a good projection, which is the one that was in the FOMC Summary of Economic Projections back in June.
Mary, let me get your take on how important debt and the cost of holding that debt is to you and your colleagues at the Fed, because President Trump obviously has been pressuring the Fed to lower interest rates, partly because of the cost of holding on to all of this debt, $37 trillion in debt, and we are spending more on the interest payments on that debt than we do on defense spending. What is your thought about the Federal Reserve taking that into consideration, as well as your mandate of unemployment and of course, inflation? Do you think looking at the debt and deficits and the cost of holding on to that debt should belong under one of those umbrellas of your mandate?
We really have the congressionally given mandate of price stability and full employment, and I'm not going to question Congress on expanding that mandate. That's their job, not ours. But ultimately, what we do know from history and experience is that if we restore price stability, get inflation to 2%, do it with a full employment labor market, then the conditions for the economy growing and sustainably growing are there. And then we'll rely on our elected officials to make decisions about how to manage our spending and taxes, et cetera. But ultimately, delivering on the 2 mandates that Congress gave us, price stability, full employment, not only helps every American, but helps our economy have the foundation of strength. So I'm really focused on those 2 things, and that's where we and how we make our decisions.
And Mary, how would you assess the macro story right now? I mean, we saw a pretty good GDP in the last quarter, 3%, but of course, we also have an eye on inflation. How do you assess the economic backdrop?
Well, it's clear the economy is slower, but it's also clear it's not slow. People are getting jobs. They might be doing it at a slower pace. Firms are hiring very slowly, but they're not laying off workers. consumers are out there spending. If you've been traveling this summer to an airport or a restaurant, you know that it's not as busy as it was maybe last year, but people are still out there. And the retail sales numbers and consumer spending numbers we've been getting, the growth, suggests that the economy is in a reasonable place. But we also want to make sure that policy is in that place that matches it. And so what we don't want to do, what I don't want to do, is be so worried that inflation might, come up again or be persistent that we wait for that clarity and don't support the labor market in a way that continues to deliver this. Wouldn't this be great if we continue to deliver, solid growth, lower inflation, and a healthy labor market? That's what we're aiming for. And because we have this policy that acts with a lag, we have to be ahead in order not to be behind.
And in terms of the inflationary story, Mary, it feels like the owner's equivalent rent and shelter keeps being one of the issues here, that we're seeing prices stay elevated as a result of that. What's behind that? Or is it really mixed? Because you do see some food also showing some gains, even if, oil prices and gas prices and egg prices have come way down.
Well, one of the things that is a good news story is that housing inflation is coming down, and it's been coming down consistently each and every month. The CPI is there. Now, that doesn't mean that prices are coming down. The prices of houses are still higher than many people can afford, and I think that really reflects this fundamental imbalance between the supply of homes and the demand for homes. We need more homes, and builders are interested in getting out there. And I think, ultimately, when they got off the sidelines back when we started lowering the policy rate last year, and with the continued expected adjustments, I expect them to be off the sidelines, creating more opportunities for people to get into homes. And if they can keep the economy strong and solid or healthy, sustainable, and have lower inflation, people are going to be able to get in there, buy the homes that they really want and ultimately probably deserve.
Mary, it's great to have you this weekend. Thanks so much.